Money Show. Personal finance.
Warren Ingram from Galileo Capital. You didn't know that?
I didn't. I'm just wondering if there are any successes they need from South African young men. I'll be over there shortly.
I was thinking of calling you Dad, actually. So, Warren Ingram, you have a good holiday.
Fantastic. Thank you very much. Did 6,500 kilometers of driving around South Africa, and I can tell you that the roads that I travelled were absolutely fantastic. I'm always blown away by our infrastructure here.
Well, that's brilliant. You clearly dodged parts of the Free State with which I'm familiar, but you didn't go to the Free State, clearly. Yeah,
I drove through the Free State quite a bit.
And you hit decent roads. Well,
yeah,
well done
fantastic
to you for
roads,
finding them. Congratulations. Now, listen, before we talk about tonight's big question, and lots of people will have questions for you, no doubt, at this stage of the day. If anything you want to talk to Warren about, to do with personal finances, to do with your money, any questions that you've got, do give us a call on 011 883 0702 021 446 0567. I see the Morningstar rating analysis of unit trusts is out, and Alan Gray seems to have regained its mojo 2 quarters in a row. Morningstar says Alan Gray is tops.
Yeah, it's really a reflection of the consistent performance that Alan Gray have achieved again in the last let's say 12 or so months. Before that, they had quite a dry patch, where their sort of value philosophy just wasn't panning out, just wasn't working with the market conditions, and their returns weren't looking all that fantastic. But it just shows you that if you'd stayed invested with them and hadn't withdrawn like a lot of people did actually, then you would be rewarded now. And the interesting thing about these the Morningstar ratings is they're really trying to understand or trying to measure consistent large managers. So you can't, if it was just me and I launched my own unit trust tomorrow, I wouldn't be rated. I would need to have 3 different unit trusts across 3 different categories that have to be in existence for, I think it's for at least 3 years. And then in total, we would need at least 5 billion under management before I would go into their ratings. So they're not looking at the new managers. They are definitely looking at the larger ones. And they're really trying to see, who will deliver consistent long-term returns. But everybody would be at pains to point out, I'm sure Morningstar as well, that a rating, a higher rating from them doesn't mean that, next year, Alan Gray, or this year, I should say, Alan Gray are going to be the star performer. If anything, history tells you that they might not be.
But that's the point I want to make is because tomorrow it's going to be talking, the personal finance pages will be full of stories going, Alan Gray is the country's top fund manager, and people are going to say, should I switch from Old Mutual, or should I switch from Sanlam, or should I switch from Coronation, or whomever, with whomever I have my investments, to Alan Gray because they are the stars. And then in 12 months' time, I'm going to switch from Alan Gray to whomever is the new flavour of the month. That's always quite high risk.
It's extremely high risk, and I think there's some other awards that simply reward top performance over a 12-month period, and those I give zero credence to. I know the fund managers love to brag about those awards, but something like this, which is looks through 3, 5, and 10-year returns, it does give you a better view, but still that doesn't change the point that you simply just can't go and chase last year's number one performer. History tells us you'd probably do better chasing last year's worst performer, and that might get you a better return. I'm not suggesting that either. I think you really need to do some homework, but don't go and chase the number one from last year.
Right, now, let's move on to questions. 011 883 0702 021 446 0567. Got an email from Clara, which made my blood run cold, gave me goosebumps, and a lot of people will find themselves in a similar position. Says Clara, I've made myself about 600,000 Rand from the sale of my house, which I must now invest as this is all I have to generate retirement income. I plan to build a small cottage on land I own near Hartbeespoort, where I live, and rent it out to holiday makers. That will use up about 250,000 Rand and generate an income of 80,000 Rand a year, which is not enough. I've got about 5 years before I retire, and I need to be wise about my investment. Any thoughts?
So just to break it into the 2 parts, I guess, the first decision about building the cottage and renting it out, and my great love for residential property, so don't fall off your chair now, but I think that's an absolutely brilliant return. So if Clara can really get that 80,000 per year from that 250,000 that she has to invest to build that cottage,
she's getting a 30% return on the capital invested. That's pretty good.
That's fantastic. So I guess a couple of things. One, my too good to be true radar always goes off when I see something like 30%. But I'm sure she's done her homework. So Clara, just make sure that you can get, that you are reasonably confident of getting that 80,000, and then that's a great decision. That's that I almost want to ask her if she shouldn't build another one. But that's over investing in one asset class. But so that's a great call, and go for it, and just be careful to manage that that properly so that you always get your 80,000.
And again, be honest with yourself when you make your projections. I don't know how you calculate your nightly rate or your weekly rate or whatever it is, and how many people you anticipate coming through and staying there, and how you're going to market it, and what it's going to cost to market it and to service the property, to ensure that you keep it at a very high standard. Be realistic about the number of people who want to come and spend their time on your property. What's going to be fantastic about your property that's going to draw these people to give you the 80,000 Rand a year? If you're not honest with yourself, you're going to find yourself short at the end of year one and hurting financially. Right?
And also, the cost, that 250,000, it seems quite low. So I guess the comment there will be that you have to chat to, and I would say get quotes from at least 3 different builders, and make sure that you understand exactly what they're quoting. Don't let them take you for a ride. And I guess it's a reality that I haven't seen a building project, I think in my own 40+ years history, ever be delivered on time, on budget. So I'm not no comment on Clara there, but just make sure that you hold them to their contract. And I would say make sure that you have a proper contract drawn up front. Go and spend a bit of money with a lawyer. It'll be the best money you can spend to make sure that you are protected before you engage with that builder, and then make sure that they're registered with the NHBRC. That I can't remember what it stands for again, but at least
National Housing Building Regulation Council or something along those lines.
You're a mine of good information.
Well, that's quite good, and that's probably wrong.
but that thing, and why that's important is just that it means that if you need to take out a bond on that property once it's been built, within the first 5 years, you can do that. And also the builder then has to meet a particular standard, and so you just don't get yourself into trouble if you do that, and really be careful of sort of a fly-by-nighter who offers to do it just on the fly, or friends and family who think that they might be good at building, because it's such a huge proportion of your money that you can't afford to take any risks, and you really can't afford to over capitalize on that property either.
Well, make sure your builder doesn't abscond. No names, no Pactra. Now, Warren Ingram.
Okay. Moving on to the next part.
Yeah, because now if there's 600,000, and she manages to get her project built on time and on spec and within budget, then there is 350,000 Rand left. If she's getting a 30% return on her investment on this cottage, that's great. Now she's got 350,000 Rand to do something magical with.
So I think the important thing here is you've got at least 5 years to build that capital up as much as you can, and I'm going to talk about I guess in 2 parts. One is building the capital up, and then the second part is what you do after year 5, and so that first the first 5 years is an important decision, because the temptation will be to try and make that capital grow as fast as possible. Make sure that that the 350,000 is as large as possible in 5 years time. And so it's almost counterintuitive when you've got a time frame like that, and you know that you're going to need income from that capital after that initial 5-year period. You actually can't take too much risk, and that's always the problem I see. When people make investment decisions, but they know they've got a limited time frame and they really have limited capital, they actually fall into the trap of taking too much risk. In other words, invest all in shares, or even worse, 3 or 4 shares only, or go and buy gold or something like that. So really concentrated views, very high risk. And the problem with that is, very high risk is great if you get the returns, but, what happens if you don't get the returns? And the stock market can easily lose 30% of its value in a big crash. Like 2008, 2009 was a big example of that. And if that happens in the 4th year of your investment time frame, then you've really got yourself into trouble. So Unfortunately, you can't take too much risk. However, 5 years is long enough that you can take significant and responsible risk. And to me, that means that you'd want to have at least about 2/3 of your capital. Let's say between half and 2/3 of your capital in the stock market. That makes sense. And then the balance can be invested in bonds, property, and cash. And property in this instance would be property companies. So if we've just been talking about unit trust. So in the unit trust world, that would be a balanced fund. Your classic balanced fund would be suitable for.
Yeah, I mean, Warren, do the rules that, I mean, in How to Make Your First Million, which is the book that you wrote and published last year, the rules apply in terms of investing money, whether you're 55 and approaching retirement with not very much, to whether you're starting out at 25 and investing R1,000 a month, or whatever the case might be. Those rules apply.
Those rules are always universal. I mean, I think that's part and parcel of the deal.
Out of that 350,000 Rand, Clara, then take 220 of those Rand and go and buy Warren's book and read it several times, and the principles of what you need to do. And also, I'm going to blow the Money Show's trumpet here, because as you were speaking, you were saying that Clara needs to boost her retirement income as much as she can in the next 5 years, and even beyond that. And suddenly the penny dropped. Our Money Show 1,000 Rand challenge. If all you do tonight, Clara, is go onto the internet and type in Google Money Show 1,000 Rand challenge. It's about 3-4 years ago where we gave 5 or 6 people 1,000 Rand each, and we said, bring us a profit. There's some great stories, including Warren Ingram, your mother-in-law, who ran a very successful little business and earned herself a couple of $1,000 a month by preparing food.
Yeah, absolutely. And I mean, you're right, Bruce. Actually, I didn't even think about that advice to Clara in terms of do something additional. And
in addition to your day job.
In addition to your day job. So we're certainly not saying give up your day job, but if you've got 5 years to get there, then do what you can, building up that capital. But I'm sitting across the desk from the rock star of that 1,000 Rand challenge, Pavlo, and he did an incredible job. But I don't think Clara could start a social media business necessarily. So be careful of that. But using your own skills and your own knowledge, it's amazing if you've got time that you can make money. And as
Absolutely.
you say,
I want to take some other calls now, but I think, Clara, I hope that helps.
Can we finish quickly on just the last part of the income?
Sure.
So just be careful, Clara, as well. Once you start drawing an income from your capital after that 5-year period, that you don't draw too much every year. In other words, if you've got, let's say for every 100,000 Rand that you've got, you really shouldn't draw more than 5 or 6% at the most per year from that capital, because you need that capital to continue growing so that it beats inflation. And a good balanced fund over long periods of time will give you about 11% a year. So if inflation's 6 and you're drawing 5, then at least in real terms, and adjusting for inflation, you won't go backwards.
Okay.
That's
Lekker.
Done.
Thank you, Warren Ingram from Galileo Capital. Busi Twala in Western area. Busi Twala. Well, we did keep holding for an awfully long time. Busi Twala, please give us a call back. I'll put you straight on, I promise. Temba in Centurion, you've got 4,000 Rand a month to invest. What should you do?
Yes, please. I would like to know what can I do. I took all my bonus, paid my son's school fees. Now I have 4,000 that I can play with. Where should I put that money?
Is it 4,000 Rand once off, or will you have 4,000 Rand every month?
4,000 a month. 4,000 Rand a month.
Fantastic.
Nice one, Temba.
Okay, so quick question.
Listen on the radio.
Temba, don't go away yet. Do you have any debt?
Oh, okay. Sorry?
Do you have any debt?
Not really. I only have my house bond that I have.
Oh, okay. So I think the question is always important, because if you've got something like personal loans or overdrafts, then you don't start investing until those are paid off. If it's only your home loan, there's nothing wrong with having a home loan on something which will appreciate over time. So my one suggestion would be that you out of that 4,000, take 1,000 and add that to your monthly bond repayments, because that's it's always good to pay off your mortgage faster than required. It also means that you'll that you'll start building up some extra capacity in that home loan. And then I think the next thing to do is take a portion of or take that money and build up an emergency fund. Something that if some emergency happens, something unplanned, where you get an expense that you haven't planned for, and you don't want to go into debt, you go into and use your emergency fund, and that should be somewhere around 3 to 6 months worth of your normal expenses. So if you're spending $5,000 a month, then 15 to 30,000 should be in an emergency fund, and that can be very simple. That can be in a money market account linked to your bank. After that, if you have got that emergency fund, then it's always a good idea to look at the tax-free savings account. It's a brilliant investment. The government actually allows us to make an investment tax-free, and maybe to do half into a tax-free savings account and half into a retirement annuity, again because you get the major tax benefits. But please use a unit trust company for your RA. Make sure it's low cost, make sure it's transparent, make sure your fees are as little as possible.
Says somebody on the SMS line here, can you manage your own RA without going through a financial advisor? So can you go directly to a company?
Definitely.
To a company? So you don't need to go via a financial advisor and pay them an extra 1% simply to put you into a product?
There are quite a few product providers out there now, ranging from the exchange-traded fund providers through to the unit trust companies, some of the robo-advisors that are making it really easy for investors to go direct and to do it at a very low cost. So absolutely, you definitely can.
Lovely. Busitwala, sorry we kept you holding so long. Tell us your story, Busitwala.
Hi, Bruce. How are you?
Very good. Tell us your story.
Bruce, my grandmother opened an account for me at FNB 26 years ago. I was 8 then. And then a few months after that, she passed away. I think she deposited about 500 Rand. So I just wanted to find out, since nobody has actually looked into that, do you think maybe there's still something in that money?
Now, you see, this is so interesting because I would be scared to go to the bank and say, hello, my granny opened an account for me 26 years ago. And they say, yeah, you owe us $10,000 in fees. But that's just me being very, very cynical. Did she put it in a safety deposit box or did she put it into a current account?
To be honest with you, it wasn't a current account because I remember there was a lot of paperwork that one needed to be done. So I'm not sure. I'm not sure exactly what it was, but I just, wanted to find out since you had...
Busitwala, please would you email me? Just go via our website, click on my face, and just email me email me the details of what you can, and I'll send it to somebody at FNB, and I'll ask them to look into it for you because I think it's fascinating. Have you got a deposit slip? Have you got some proof that this money was paid in for you?
I think I can find it.
Okay. Any detail? Have you got the account number or anything like that? Just send me any detail you can and I'll forward it. Busitwala, what an interesting question, Warren Ingram.
Yeah, and if Busi doesn't have the account number, definitely then an ID number will help a lot.
Okay.
But it's
only grannies or your own,
definitely grannies as well. And I think it's an interesting one because those fees shouldn't have eroded the capital, and it'll be interesting to see 26 years ago, if you remember, or you will remember, you remember everything. But inflation was quite high, which means interest rates were quite high. So it'll be interesting to see how much it's actually grown over that time. Very few people actually leave money for that long, and so it'll be amazing to find out.
I was told, please email me and let's see whether or not we can find out. Let's solve this little mystery. One does like a good mystery, and then we can report back on it as well. 26 years ago, FNB, $500. If you average 10% over 26 years, there's a tidy sum of money in there, Warren.
That's, I don't, my maths isn't that good, but I think it'll be a decent amount. It'll be a really nice deposit on something.
It would be. Now, Warren, are you feeling optimistic about 2017? This time last year, you were getting razor blades, you were going to buying Menorah razor blades, and you were sharpening them extra sharp, and you were quite gloomy about the year that would be 2016, and it was a tough year, but it turned out better than I think practically everybody thought it would this time last year. Are you feeling a bit more optimistic about this year?
I am. I think I think a lot of the discomfort from last year is gone, from the point of view that we realize that our whole political system does actually have checks and balances, and that poor decisions do get corrected, unfortunately too late. I don't think that those risks are gone, but what's also changed, I think, is if you look at the commodity cycle, it's certainly not too early to say that commodity cycle has turned. It's not going down anymore, and things like chrome are up in enormous amounts of I think it's from sort of $50 to $300, something like that. And you look at the resources companies are generally recovering, and then it looks like in large parts of the country the drought is over. And so if we just get a stable rand, which I know is a big ask, but if we do, then the economy is looking in much better shape than it was a year ago. And all we need now is our politicians to do nothing. Just please stop messing up. And
don't go to work. Just do nothing.
Just do nothing, and let business and let everybody else just try and make a living. And we all want to grow, so we'll get there.
Warren Ingram, financial advisor at Galileo Capital. Thanks very much. First contribution for 2017.